I think we're in a good place to start. Welcome to today's webinar. You're here with us today. We are your hosts, myself, Manar, co-founder and co-CEO of Stake. We're joined by two representative of InvestCorp, Khulud Ibrahim, who is an asset specialist, and Alex Bennett, who is principal in their investments team. This is a very exciting time for us as we, partner with, the best in class when it comes to investing in the US, and that's why we're happy to kick off this webinar with everyone. The agenda today is in front of you. We're going to go by, starting off as usual with this small intro on who we are as Stake, and then moving on to expansion to the US and why invest in the US industrial real estate market. Then a few words on the Stake and InvestCorp partnerships, and we could deep dive into the fund and take some Q&A next. I'll kick off with the starting point here, which is all about, what we're all about at Stake. And we basically set out to solve a problem that is, prevalent in the real estate market at large. Essentially, people don't have an easy and low cost and digital way to invest in real estate. We saw this from the beginning when we first began the company. Our mission was to empower everyone to own and build wealth through real estate. It all started with several pain points, starting with the high barrier to entry, and so we called that the restricted access, essentially. That the asset class usually requires a high ticket to enter it, and so we sought to lower the barrier to entry as low as 500 dirhams. The offline and clunky way of buying real estate, the traditional way, is an ancient kind of way of operating based on what the age that we live in, and especially in the new post-COVID and AI age that we live in. It's no longer acceptable. So it should be a delightful experience that's online and digital for us to buy real estate. And in the same way that you lower your ticket entry into the asset class, you're able to not concentrate your portfolio, which is a game changer for investing in real estate. Of course, with the same amount that you're looking to deploy to the asset class, you can kind of diversify across different properties, different asset classes, different geographies, even now at Stake. And the real estate market tends to be really difficult to find accurate and transparent data. We sought to provide our investor base with as much information as possible to be able to make informed decisions and create your own bespoke portfolio, unlike how typical REITs are, where you basically give your money to a fund manager and have them allocate the funds to different assets, kind of at their own discretion. And really, and on the subject of REITs, this real estate investment trusts in our region are virtually non-existent. And so, there is a really strong case for, investing in real estate through an app like Stake, and giving you investors the best selection that you deserve, of course, in that we would do the vetting in-house and select the best assets in the market, and obviously help you from a convenience standpoint, just basically collect your rental income and ultimately realize your capital appreciation. And so there's no alternatives for that kind of product, and we really sought out to deliver all these value propositions. And the last one is really, once you're in the asset class, we wanted you to get out if you need, just as fast. as if you owned a full property, or even faster in the future. We're looking at ways to make the liquidity, a friend of yours in this asset class, as opposed to a hurdle. Next slide, please. So since 2021, we've enabled 1 million plus users from all over the world to access properties fractionally, and private real estate funds as well, in our two core markets, the UAE and Saudi Arabia, which have benefited from tremendous growth. These users are based all over the world, as I mentioned, 200 plus nationalities coming from over 170 different countries. We've been fortunate enough to distribute over 50 million dirhams worth of rental income, and we've basically transacted on the platform more than 1.3 billion dirhams over these years. And as you can see, we still pride ourselves with our excellent score on Trustpilot and other reviews that really give us the confidence that our user base is loving the product and loving the asset class that we're delivering in the digital and convenient way, as I mentioned before, as we do. So we always say we really want to provide a delightful experience for our investor base, and that has translated into growth, tremendous growth over the years, and we are really excited as well to continue that path, as we see so much potential across not just our core markets, but now entering into new markets like the US with InvestCorp. If we can move on to the next slide, please. Yes, so now we are helping you not just enter into the UAE and Saudi real estate markets, but also to diversify your portfolio into the US real estate market. And that's the first of its kind. No app on this planet allows you to enter into multiple markets into real estate from as low as $150. And that experience for us is really kind of a testament to our vision, which has always been to build a world where real estate is fully open, accessible, transparent, borderless, and liquid. And borderless became a reality for us when we launched Saudi real estate funds. But now we're we're making that more of a reality, even with US real estate funds, with the best in class, as I mentioned earlier, InvestCorp, whom we're so excited to partner with, and hopefully can chart out a path for more transactions in the future into the US market, which is a very promising one, and you'll hear all about it next. With that, I'll hand over to Khulud to walk you guys through why it's a good time to invest in the US.
Thank you, Minar, and I think on behalf of InvestCorp, we're really also very, very excited about this partnership. We're happy to put our expertise at your disposal. Obviously, when it comes to real estate investing, InvestCorp has been a long-term kind of investor into real estate, been investing for over 40 years. But the US as a market, why the US? Obviously, it's the biggest real estate market in the world. You have, billions of dollars of transactions happening on an ongoing basis, different sectors, different strategies. We've found this market for an international investor who is looking to diversify their portfolio. It's you absolutely have to have an allocation to investing in the United States. Strong performer, long track record, transaction volumes, as we've mentioned, which allows us to buy and sell with ease. There is transparency in the market, so it's very easy for us to get information, to be able to analyze certain opportunities, to find out, to go through market discovery when we have certain investments, when we're buying, when we're selling, so many different kind of participants. And worked on honing our kind of investment process to be able to get the best outcome for us and our investors. Obviously, other reasons why we really like the US dollar, obviously the currency. For a lot of us here in the Gulf, we are kind of, the dollar is very closely linked to our currencies. It is the world's global reserve currency, so it's definitely a good diversifying and exposure to have in your investments. Very one of the other kind of reasons that we strong points for investing in the US is that there's a very well established and strong legal framework that is to the benefit of the investor. The rules are clear. We know exactly what we're dealing with, whether it's and then whether it's on the federal level or even on the state level. We know exactly how to structure investments to be able to extract as much value to our clients from these investments. So obviously, I think it's for us, this is our home base. The majority of our investments into real estate actually do happen in the US, and that's been a market that's tried and tested, and definitely a market that we continue to have very, very high kind of conviction in. I think if we move on just from why the United States to why industrial, again, I think the industrial real estate sector has been, one of the most attractive and most prominent sectors to invest in real estate. And when we say industrial real estate sector, we basically means we're investing in warehouses and some industrial properties. We have a specific kind of strategy here, and for us, our focus is really on, warehouses that are very close to densely populated areas. We do want to be kind of very close to the end consumer when it comes to people who are, utilizing e-commerce and expecting delivery. So the time of delivery is also kind of very important here. The sector in general has been a top performer. We've seen resiliency throughout different parts of the investment cycle. We've seen that it's the level of vacancy has always been quite stable and very minimal. The growth in demand for this type of real estate has been continuous, and it's been driven by different factors, and we'll talk about them in a little bit. But I think the consistency or the continuous demand for these types of properties, whereas the supply is very little or does not satisfy the level of demand that we kind of see, makes for a very healthy fundamental. It allows us to continue to keep these properties well occupied, and also enables us to push the rents with tenants over time over our investment horizon. So good, predictable kind of cash flows, with also opportunity for upsizing and pushing the rents higher throughout our investment hold period. Now, why is industrial kind of real estate continues to be favored by some of the largest investors, whether they're institutional investors, family offices, ultra high net worth individuals, and very soon at lower kind of minimums investors who are coming into this. If we go to the next slide, I think we see that even on the legislative level on the US, there has been a lot of different laws, different policies introduced that actually encourages one kind of basically coming back, bringing industrial and manufacturing back to the United States. I think that's a trend that we have seen in the past 4 to 5 years. So just kind of rely more heavily on internal resources rather than rely on international kind of supply chains. We've seen a lot of different policies, whether it's on infrastructure bills and investing more in infrastructure, or the very, very recent US tariffs that were introduced a few months back. All of that has has tested the resilience of the sector, and we've seen that, for these kinds of investments where we own millions of square feet, and all across the United States, it's had actually fared extremely well, continues to hum along, continues to grow, and manage all of these different events. So on a kind of big picture kind of level, just bring it back. But the one of the biggest factors, we can go to the next slide. Thank you. One of the biggest drivers of the demand for industrial product is basically the introduction or the start of e-commerce activity, buying online, and that has been growing. And as much as each one of us, I think today, I'm sure all of us have, are ordering things online, buying things, expecting delivery to happen on a very short period of time. That, as a percentage of total retail numbers in the United States, that has been edging up over time, let's say over the last 10 or 15 years. It went from, let's say, close to 6-7% as a percentage of total sales till today, where it's at 16 to 17%. So a lot of growth, but still a long way to go. There is still a lot of transactions and retail activity that's happening that's still not online. So there is a huge tailwind to the sector to perform and to grow over time. And so, I think this really helps us kind of form the thesis for us on investing in these kinds of properties. So I think historically, we've seen that the sector has performed extremely well. It has very good momentum. The tenants, if we look at our tenancy or the demand on these properties, it continues to be very strong. So this is why we really like this sector. I think maybe I would hand over to Alex, who's going to talk a little bit more about how Investcorp kind of handles the investments in particular, and then talk about the opportunity itself.
Sure. Thank you, Khulud, and thank you everyone for your time. My name is Alex Bennett. I am a senior member of the acquisitions team here at Investcorp, and I led both investments that we're here to talk more about today. Just to give you a high-level view on Investcorp. Investcorp, we are a global alternative investment manager with about 60 billion in total assets under management. As Khulud mentioned before, we've been investing in the US for over 40 years, and over 30 years specifically in the US real estate market. So very well versed and experienced in US real estate specifically. Investcorp is a top 50 real estate investor. And our existing industrial portfolio within the US spans about 45 million square feet and is valued in excess of $6 billion. As Khulud also mentioned, our strategy within the industrial space has been very consistent over the last several years, in that we've been targeting multi-tenanted, diversified industrial assets with strong in-place cash flows, and that are closely located to dense areas from both a employment and population density perspective, and also have a strategic logistics and transportation infrastructure. Our approach has been focused on top 50 US markets, and the two deals, or the one investment that we're talking about today, is consistent with our approach, which has been successful to date. We can turn to the next slide. And I can dig into the next slide as well, which outlines the opportunity here today. So the portfolio that we're discussing today spans about 2.6 million square feet, 27 different buildings, and 2 different markets within the US, Baltimore and Minneapolis. This portfolio is very well diversified. It's currently 94% occupied today, to about 80 different tenants or businesses operating across various sectors of the economy. This includes third-party logistics, wholesaling, construction and materials, as well as commercial supplies and services, among many others. All of the assets within the portfolio are highly functional and desirable to a wide range of tenants and businesses who are servicing both like the local and regional population bases, but also the broader kind of areas within the United States. Just to talk a little bit more about the markets here, Baltimore and Minneapolis are both top 25 markets in terms of industrial market size, but also population bases. Just to start on Baltimore, Baltimore is a strategic logistics market that's located along the U.S. East Coast, within the I-95 corridor specifically. I-95 is a major interstate that runs along the entire East Coast of the U.S., so all the way up to Maine, through the Northeast, Mid-Atlantic, Southeast, to the state of Florida. So, being in a market along I-95 has a lot of strategic importance to service, both the local, regional, Baltimore population base, but also markets that include, Philadelphia, New York into the Northeast, and, South, Washington, D.C., and the Carolinas. From a fundamental standpoint, Baltimore is a strong performer. It's the 24th largest in the U.S. from an industrial market standpoint, with about 280 million square feet of inventory and an occupancy rate of approximately 93%. So industrial opportunities in Baltimore are highly coveted by many institutions, and we're very excited about this investment. And just shifting gears to Minneapolis briefly, Minneapolis is a centrally located, metro within the United States. Demand drivers here are driven, both by the central location and the ability to service, a wide population base, both within Minneapolis, but also, the Midwestern part of the United States. And the market also benefits from very strong demographics associated with a really robust presence of major companies. So, 17 Fortune 500 companies are based in the Minneapolis market, which really anchors and drives, demand. Minneapolis, like Baltimore, is a top 25 market, so a population of about 4 million people. It's the 17th largest industrial market in the country, with about 357 million square feet and a current occupancy rate of about 96%. And just to kind of close here, the business plan, I'd say, is very straightforward and consistent with Investcorp's industrial strategy, in that we are going to increase in-place rents, when leases expire over the investment holding period. Rents today are approximately 20% below market rents. So, as leases expire, once again, we expect to, increase, those rents to be in line with market. In addition, we're going to maintain and operate the assets, to be consistent with institutional standards. And, that entails leasing and addressing minor capital expenditure needs, as they come up over the hold period, that include roofs and, parking lot repairs. Other than that, very excited about both of these opportunities, and to, partner up with Stake.
Great. So we've reached the stage in the presentation when we want to take all your questions. We kind of leave a bit of time for that as we see the Q&A start to flow in. So please don't hesitate to drop us any comments or questions that you have that you want us to address. I'll start off with one of the questions I see in front of me, which is from Ahmad, that is asking, what are pros for putting our money into this fund apart from diversification when compared to a lesser percentage of ROI as compared to properties in Dubai? And if I understand correctly, uh, this uh, this investment in the US, you feel is potentially less attractive than properties in the UAE and in Dubai. And I want to kind of just kind of give this idea a bit of a challenge because of course in Dubai we are seeing fantastic growth on the capital appreciation side of things when it comes to the overall market. And if you've been an investor with us, you've seen all that growth in the value of your portfolio. But the dividend side of things has been, increasingly because the market's been going up, increasingly, kind of, staying same or reducing actually as a percentage of your investment, and still, the most attractive yield for a residential market of a global international city, um, the most attractive in the world. Uh, but you have a chance here to make when we look at our strategies in Dubai, they earn anywhere between 5 and 6% yield. Here you have a chance to make 1.5%, even 2%. Actually, on average, you're talking about 7.5% uh, coming from the US, and so you're making a pickup on the dividend yield side of things that may compensate for the uh, variable return that you're seeing on the capital appreciation side of things. Of course, our ROIs in Dubai have tended to touch, double digit to get to, 10%. Um, and here you're not so far off. We're anticipating that you can generate close to 9% or 8.66% to be specific, total ROI over the course of a 5-year hold period. Um, Without going into diversification, I think the stability of that cash flow coming in compared to Dubai is an attractive proposition. Dubai, of course, where we select properties are where the residents are finding are seeking properties, and they are the most in demand areas, and we're very kind of diligent in our process to select them that way so that vacancy risk is mitigated. But in terms of your your profile of risk here, it's really attractive to be in the industrial sector in the US because it's pretty defensive. There's very little supply of that same type of asset. And in markets, as the team at InvestCorp has just walked us through, in markets like Baltimore and Minneapolis, where the advent of growth in e-commerce, and we're only seeing future growth in that space as e-commerce chips away from into the global economy, increasingly so. When you look at its share of global trade, it's only a small percentage of global trade that's happening online, and that's only earmarked to grow from here. Of course, it's seen a fantastic run post-COVID, but there's more ahead of us in that space. So the demand side of the equation on warehouses in Baltimore and Minneapolis, which are some of the most established industrial cities or markets in the US, it's really a defensive play as opposed to when you're looking at something like residential properties in Dubai that yield lower and grow faster or grow higher, slightly more by like 1 or 2 more percent. But in terms of risk, this is lower risk the way kind of we see things because there's more demand and less supply and just long-term tenancies. You're talking about 3 years of tenancies secured on this portfolio plus that's the weighted average lease term. So I hope that answered your question, Hamad, why you should consider this investment, even if it's a lower percentage in total ROI terms compared to Dubai. I'm gonna jump into tax implications to invest in this fund for UAE residents. So firstly, to tackle this one, we got to say US taxes are fully kind of covered by the structure that Khulud mentioned earlier, that Investcorp has really built a expertise in over the years to make sure that leakage for tax is minimized. And so what you're seeing in terms of returns, these are all returns net of US taxes when it comes to dividends and capital gains. But because this opportunity is being offered to you guys in the form of a fund based in Saudi Arabia, and it's Saudi Riyal denominated, the Saudi withholding tax will apply to dividends and also any profits generated. And that's just for anybody that's based outside of Saudi Arabia that will be subject to that. And it's 5% of just the profits. So if I were to give an example on the dividend side of things, the 7.5% yield that you'll collect on a monthly basis, or it's an annualized yield, they're going to get distributions on a monthly basis, will equate to 7.125% after taking the 5% withholding tax away. And that still, just addressing, referring to my previous question, but the previous answer to the question of the total return, that's still a big kind of step up compared to the 5.5 roughly average yield that we're able to generate on residential property in Dubai. So it's a 1.5% that's significant, at least, that you can generate from this portfolio here. If I may pass on to either Khulud, I think this one's for you, Khulud. When it comes to the Sharia structure here, one of our users is asking if you can advise how are these structured to make them Sharia compliant?
Certainly. Thanks, Manal. So on these investments, the way that we structure them to make them Sharia compliant is that, first of all, this is done through an ijara contract. So basically, what we do, the way that we kind of structure it is that we have at the property level what we call a master lease agreement that kind of basically shields the investors from any type of financing that's non-Sharia compliant. And so basically what they do get is that they get all the economic benefits of the income coming from the property without having direct exposure to the financing itself. We've used this structure for over 20 years. It's been kind of tried and tested. It's been approved by our Sharia scholar. And in addition to kind of just the structure itself, what we do is that prior to us acquiring these properties, every single one of the tenants has already been vetted. What are they using the space for? Is their business Sharia compliant or not? And so that we've already kind of gone through the entire list of the tenants. And so we know that, all of their uses are permissible. And the structure also kind of does that to deal with the financing aspect of it. So the investment that you are coming into is Sharia compliant. We do have a fatwa actually in place that we're happy to kind of to share that kind of confirms all of this. And this is something that we do for the majority of our investments in real estate in the US.
Great. Thanks for that, Khulud. I'll address one question here from a UAE investor. Does the currency movement from AED to Saudi Riyal, then from Saudi Riyal to USD now, and from USD to Saudi Riyal, and then Saudi Riyal to AED for the payments, as in the distributions, I think, together with the withholding tax at each step and the currency exchange prices, and fees and all affect the ROI and cash flow. So let me address those one by one. I think the AED to Saudi Riyal currency exchange is one that you'll be subject to entering into this investment, and it depends on your banking provider usually, or your card provider, how much is being charged at that kind of entry level. We've seen rates from 1% all the way to 3 or 4, and that's just the cost of converting currency from one market to the other, and that's charged to you when you're making a payment with your card, or you're transferring money via wire transfer, and wire transfers, depending on the amount, you could get more competitive rates. We are actually looking to solve that pain point, particularly for all the international customers we have around the world. And that's a product that's in the roadmap coming, hopefully, early next year. But coming from UAE to Saudi, there will be uh, that conversion cost. But when it comes to Saudi Riyal to dollar, we have secured a very, very attractive conversion for the total amount of investment that's coming out of this fund into the US portfolio. And that there is little, if none, in terms of cost for that conversion to happen, because it's happening at the rate that is fixed, because both the dirham and the Saudi riyal are pegged to the US dollar. So there's not much by way of currency risk and fluctuation that you're taking here by making this investment. And the cost that is involved from converting to Saudi riyal to dollar is very competitive. It's at the kind of screen rate, or slightly more. So there, to summarize, there's no leakage almost, or very little, coming from Saudi riyal to dollar, and vice versa, dollar to Saudi riyal. You will obviously, in the same way that your entry from dirham to riyal was costly to some extent, depending on your bank, you might be faced as well with more costs on the way out, in addition to the withholding tax that I mentioned earlier. So roughly speaking, we don't anticipate these costs to be impacting your total returns by more than 2 or 3% compared to if you were investing, straight in dollars into the the InvestCorp master fund. And so this, to answer your question, it's not going to be heavily affecting the total return on investment the way we see it, except for just the 5% withholding tax if you're based outside of Saudi Arabia. But again, our view is that it's still attractive, and of course, given the risk profile, the return that you're making, and the access point that you're getting into this portfolio, which was never done before, is really a value proposition you shouldn't miss.
Hey, I can. Looks like there's a question about the bridge collapse in Baltimore, the Francis Scott Key Bridge, and how that impacted the industrial market. Of course, there was a bridge collapse back in March of 2024 that impacted the Baltimore port. And I think that's really the theme in terms of like the impact as it relates to industrial real estate. That bridge was located, near and around the port of Baltimore. And the tenants within the portfolio and really the broader like Baltimore market, are not directly servicing the port. The port is, of course, a notable driver of the economy there. But Baltimore really is a diversified economy, and that's one of the reasons we really like the market. Total port-driven employment in Baltimore is less than 10%. So it kind of demonstrates how diversified Baltimore is outside of the port. As it relates to the impact that we saw and have seen, it's really been, de minimis because the tenants here are not, directly, reliant on the port. So I'd say there's very, limited to minimal impact, historically. And, as it relates to, currently, the port is operational and up and running. And actually 2024 was the second busiest year that the port ever experienced, despite being down for about plus or minus 11 weeks. So really minor impacts there.
Great. We have some more questions flowing in. The first one is, any plans to allow cross-currency investments? For example, can I use my AED wallet to fund my Saudi Riyal wallet? This is in the making. Unfortunately, it's not live yet. But wallet-to-wallet movements, we need to separate the wallets from a regulatory standpoint. Again, to the point that I mentioned before, no other platform is allowed, two different regulatory kind of licenses to be joined in a single app experience. And so we need to kind of maintain some level of segregation, but movements from wallet to wallet should be part of our product, and we're working hard at delivering that. It's not yet live, but now you would need to withdraw your AEDs to your account and then transfer them to the Saudi Riyal account, or use a card just to go straight into the Saudi Riyal investment. I pressed live answer on a question that I was meant to type, and it's a question that I already answered, but once more, is the 7.5% dividend a net after all costs? It depends where you're based, is the answer. If you're in if you're in Saudi Arabia, you will not, this is your net dividend yield. But if you are based outside of Saudi Arabia, you will be subject to a 5% withholding tax, meaning the 7.5% drops to 7.125%. How much does Stake and Investcorp charge for fees in this fund? So all fees are disclosed in our documentation on the app. You have a private placement memorandum that Investcorp has made available that outlines fees that are applied by Investcorp. And then when it comes to Stake, us and the feeder fund manager are charging a 2% additional subscription fee for entering this transaction. So that is, in the process of making an investment, you will be able to see that it's a levy on top of your subscription amount, just like any other Saudi fund that we've launched in the past. Can you share about exit strategies? This is a good question, Alex, maybe for you and or Khulud to pick up on this portfolio. What's the kind of a vision for what happens in 5 years' time?
Sure. Yeah, I can take that. So I think one of the things that we really like about the investment here is that there's really good optionality and flexibility to exit the portfolio. I think Investcorp's default stance is to optimize and to maximize return. So we're always really evaluating ways to do that. I think the underwriting and the assumptions assume that the portfolios are exited separately. So Baltimore is exited together and the Minneapolis exited together. I do think in reality there's a decent likelihood that we can carve up the Baltimore portfolio and look for ways to exit the most accretively, potentially offering a smaller component for potential investors to buy at time of exit. So Baltimore specifically, it's located across 4 different submarkets and locations within Baltimore. So it does break up, fairly well. And then, Minneapolis is located in one submarket, but there's three different parks or concentrations of buildings. So, once again, that also presents an opportunity, to be broken up in a very natural way. So it's something that's always on our minds, and we'll continue to evaluate it, when the time is right.
Brilliant. Is there any legal obligation that arises for tax filing for any of our unit holders or investors in the fund, since they're making an investment there? Maybe a different way of putting what I
Yeah.
said before.
Yeah. I think it's the same answer. We basically, from the InvestCorp side, we take care of handling all the taxes. In fact, I mean, the structure that we put together shields all the investors from the tax authority in the United States. So we are the entity that's facing it. If there are any taxes that are due or needs to be done, it's done on the structure level. InvestCorp takes care of it. None of the investors in this fund are required to file any tax forms with the United States. So that's
Great.
already handled, and it's part of the net return that Manar has spoken about already bakes that and takes it into consideration.
We have another question about what happens in 3 years after, let's say, the current leases or the weighted average lease term, broadly speaking, reaches its term. Like, can we expect higher rents? Is the question.
Yeah, listen, I think, on a historical basis, both Baltimore and Minneapolis have, showed impressive ability to achieve strong rent growth over, 5 and 10-year periods. That's averaged from 4 to 5% historically. Rents today are plus or minus 20%, as we stand here today. The projections assume a more moderate and conservative, level of rent growth, looking forward of, plus or minus 3%. So I do think, there is an opportunity, after 3 years, once, the mark-to-market opportunity, has been extracted, to continue benefiting from, rent growth in both markets. And, it really goes back to the supply and demand fundamentals, that we talked about earlier. Supply for this kind of space and in these buildings and locations, is highly constrained, given, one, lack of available land to redevelop, and two, rising construction costs really inhibit new development, for assets like these, that are located, so close to households and offices and, transportation infrastructure. And then on the demand side of the equation, as Khalid pointed out, the e-commerce shift, that continues to grow pretty exponentially, really across the world and within the US, plus the impacts of, onshoring and supply chain logistics. That's really, generated a very favorable, operating environment that we expect to continue into the future.
Thanks, Alex. I think there was another question related to the procedure of realizing the capital appreciation or distributing it at the time of exit or maturity of the fund. Maybe you guys can kind of walk us through how it typically works. What are you looking to do exactly at the time of exit in order to return back the capital, plus some of the upside that is on top of the dividend yield on this investment?
Khalid, do you want to handle that one, or would you like me to?
Please go ahead.
Yeah, so I mean, at exit, right, in 5 years, we, of course, are realizing, income from the properties. And then, of course, we'll look to exit the portfolios. Like we talked about, there's flexibility there. So once we realize, the value of the portfolios, at time of exit, there is, financing and debt that we need to pay off. And then, the remainder, is, distributed and sent back, as a return of capital and hopefully profit as well. So happy to go into more detail, but let me know if there's something else in particular that was being asked.
No, I think this should suffice. Which three industries account for the majority of the warehouse tenants? And why did you land on a top 25 market versus a top 10 market for industrial warehouses?
Yeah, sure. So from a tenancy standpoint, the three main industries are third-party logistics, I'd say industrial services and supplies, and wholesalers. I will say though that the tenant industry mix here is highly diversified. And that's one of the reasons that we have implemented this approach across our industrial platform is that there's no significant exposure to one industry in particular. So once again, very high levels of diversity across of course markets, buildings, but also ultimate tenant industries. As it relates to the markets here, Investcorp's approach is targeting top 50 US markets. Both of these happen to be top 25 markets. Both of which we are very comfortable with and well-versed in investing in historically. So we do have experience, investing in U.S. real estate in both the Baltimore and the Minneapolis markets. So very comfortable and once again feel confident about both opportunities despite them not being quote unquote top 10 markets, which would naturally limit or be very limiting to our strategy and approach.
Great. That's a great answer. Going back to the question of exit, someone is asking if the fund is guaranteed an exit after 5 years. That's kind of maybe something we can kind of shed some further lights on. Either you, Khalud, or Alex, on that note, just to highlight what happens again towards the end of this fund.
Sure, I can take that. So basically, and I think as Alex has mentioned, we buy these properties, we have a certain business plan in mind to kind of execute, to renew the leases, extend the term of these leases, push the rents higher up. Once we believe that we have executed that plan, which realistically, I think just considering the number of industrial properties that we've already kind of exited over time, is that once you execute a particular plan, or for example, for a certain building, you've built up the occupancy and it's maxed out at 100% and at a very healthy kind of rent level, it naturally lends itself to an exit scenario. And so what we do is that we start to look into potential exit options way before the 5 years actually kind of happens. And so maybe you start to see some partial sales and we start to sell some of those properties, winding up all the way to kind of close to the 5 years. Now, if year 5 comes and there is, for example, some kind of market shock or market event that's not very conducive to us being able to exit that investment, we are not going to be forced to sell at a dislocated kind of market situation. We do have the ability to keep these properties until the market normalizes, until you think that you can get the maximum return for your investor for these investments.
Fantastic. We have room for a couple more questions. Let me try and answer this one, which is mentions 3 years of rental tenancies are secured. What about years 4 and 5? So we mentioned earlier that there is a potential for higher rents. We've assumed a very conservative uplift in the rental values, but there is definitely upside to that number. And so given that the supply demand dynamics in this particular market, in these two particular markets, are in favor of kind of no similar assets being widely available, and growth in the underlying kind of businesses or tenants is anticipated to continue. We still see a high occupancy and a high rentability or renewals or releasing of the units and these individual properties in the portfolio. And so that's what happens basically in year 4 and 5. You will get whatever uh, the new rents will distribute, which is anticipated to maintain at least the same 7.5% dividend yield from the rental income for you. So all we're saying is that tenancies are secured for 3 years. Unlike, for instance, in Dubai, leases are 1 year and they're renewed annually. But here, you have your contracts that are longer term, and there's a weighted average lease term on the portfolio of over 3 years. That's why your rental tenancies are secured for that period. You can really rely on that cash flow coming in. That's more secure than if it were otherwise. Um, any future plan to expand in other types of industrial real estate, like manufacturing, infrastructure, production of facilities, agri, medical? Look, I can pass that question to Investcorp as well. Of course, you guys see most of the deal flow, and you've seen all the different sectors of industrial real estate, and can comment on that. We as Stake, we are, keen to participate on where, Investcorp finds that value, and it can be, composed of different categories of real estate or asset classes within real estate, not just industrial, but we're talking about new transactions coming in different other sectors. Your data centers, your student accommodation or your student housing, and so on and so forth. Those would be fantastic additional categories of real estate to give investors access to through Stake. So we're looking at those. But when it comes to specifically industrial real estate, maybe Alex, you can comment on that.
Sure. Yeah. Listen, we're constantly evaluating all sectors of real estate. I will say within the industrial strategy, this program and this opportunity really represents, our highest conviction strategy within industrial, and that's the multi-tenanted infill, diversified, portfolio execution, that we kind of outlined before. So, I will say like we have a portfolio of about 45 million square feet that, looks and feels very similar to this. We've experienced good success and continued momentum. So we're very excited about, presenting this opportunity, just given it's, we've done fairly well, and we, expect to continue that into the future. So, this is definitely our, very highest conviction asset class right now and strategy.
Great. Thank you. And one final question. George is asking if we are planning to have the same residential offering that we do in Dubai in the US, which is, let's say fractional apartments or villas. The answer to that is, at some point, yes. We are focused on now entering, markets like the US through best-in-class partners, as I mentioned. Investcorp has a long track record in history and expertise in the field, and this particular sector itself has been one of the highest performing historically. So we're extremely excited to give that opportunity on the app. But when it comes to us operating on the ground in places like the US and fractionalizing properties, that time will come once we, I think, grow and cement our positions in our core markets, the UAE and Saudi Arabia, ourselves, and establish our dominant position. We'll start to plant flags in other markets in the future. I think we're running over time, but the questions keep on flowing in, and I have to, put a stop. But we'll try and answer your questions. They're recorded here. We'll try and answer your questions offline. And thank you so much for attending today's webinar. I hope it was useful and informative for your decision making on the app. And we keen to get your feedback. Please do share. Thank you for joining us again. And to the next time, we will continue delivering the best opportunities that we can seek out there from the market. So pleasure to have you guys today. And with that, I'll close till the next time. Thank you, Alex and Khulud, for joining us today. It's amazing to have you guys on board, really giving us this education about the investing in the US and the industrial space.
Of course. Thank you for having us. Thanks, Manal.